today. And we'll do some introductions in just a moment, but the first thing I would like to talk about is that we do have dual interpretation today. So what is going to happen is I'm going to turn on the interpretation. And once I do, if you are on a desktop, you're going to see a little globe. You can see that here on the slide. You're going to click on the globe and you must choose a language. Even if you wanted to be in English and you can still hear me in English, please choose English as the language. The other option will be Spanish. And if you're on a mobile device, you're actually going to click on More. There'll be a drop down, and please pick Language Interpretation, and then choose the language. But right now, you won't see anything until I turn this on. But Emily, I'll turn it over to you to explain to our Spanish-speaking participants.
Perfecto, bienvenidos a todos. Vamos a empezar muy pronto y primero queremos introducir la función de interpretación. En un momentico vamos a encender el canal de español y puede ubicarse al fondo de su ventana de Zoom. Ahí hacer clic en el icono del globo. Debajo dice interpretación y ahí van a aparecer las opciones para usted escoger inglés o español. Si se está conectando con móvil, verá a donde dice más y hay 3 puntitos. Puede escoger también la interpretación por ahí. Primero interpretación, pues el canal deseado, pues listo o done, y ya está en el canal. Si tiene cualquier dificultad, por favor, déjanos saber en el chat porque no queremos que nadie se pierda nada. Gracias.
Thank you, Emily. Aaron, because we have you in as the host, I believe you have to turn the interpretation on.
Okay, the interpretation function should be on right now.
Fantastic. Everyone, please choose the language that you would like to hear the presentation in. I'm just going to get started just a second. I have to choose a language. And let's get this party started. So hello, everybody. Thank you so much for joining us today. My name is Jen Vale. I'm here with my coworker, Aaron, and our interpreter, Emily. And we would love to welcome you today to Understanding Business Debt. So I'm excited to guide you through this crucial aspect of managing your business's financial health. Throughout our time together, we'll explore how business debt works. We'll learn to evaluate the different financing options and develop some strategies to make informed borrowing decisions that'll support your company's growth while maintaining financial stability. So I do apologize if we run through things a little fast today. There's a lot of content. Just before we start, here's our disclaimer. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute, an attorney-client or any other advisory relationship. Reproduction of this information and the recording of this content, including the use of AI, is expressly prohibited. Only non-commercial uses of this work are permitted. All right, so we're going to jump into some crucial topics for your businesses here. So what we want to do, where we want to start is understanding the true cost of debt, right? Beyond just that amount that you borrow, because that will include interest rates, the repayment duration, and any potential consequences that could come up. We're going to guide you through the process of assessing your debt to asset ratio. Debt to asset ratio is a key indicator of your business's financial health. And then we're going to walk you through what an effective debt repayment plan looks like, making sure that you're going to tailor it to your business's specific needs and capabilities. We're going to discuss how you can recognize warning signs that your debt might be becoming unmanageable, and we'll help you catch potential issues early. And finally, we're going to explore professional debt management options that are available to you if you needed additional support. So by the end of this webinar, we will have a comprehensive understanding altogether of how to manage debt effectively for your childcare business. All right. So whether for personal or business reasons, nearly everyone will encounter debt at some point in adulthood, right? Debt is very commonplace. It can be really easy, though, to focus on the advantages, and sometimes we overlook the potential risks of borrowing money. So while debt can be a tool that can support your business's resiliency, allow you to be sustainable, help you to grow, when used properly, there are two notable issues that are very important to recognize. So first, when you borrow money, you usually have to pay interest, right? So that means you'll ultimately be paying more for the total amount that you owe, more than what you originally borrowed, right? Even if it's a worthwhile investment, if you don't really know the terms of your agreement or you don't have a good plan for paying back the money that you borrowed, you could really end up losing a lot more money than you realize, or finding yourself in that cycle of debt that is really, really difficult to escape. And then second, depending on your current circumstances and the type of debt that you're taking on, borrowing money may come with great risk, right? Because committing to repayment, it can stress your finances, especially if you're already on a tight budget. High monthly payments can limit your ability to save, invest, to cover unexpected expenses, and that leads to increased stress and financial instability. In addition, some types of debt, like mortgage and home equity lines of credit, which you probably know as HELOCs, well, those are secured by your property, right? So if you're unable to make a payment as you agreed, you could risk foreclosure and the loss of your home. So that's some pretty serious things right there. We have to keep in mind, right, that debt can be a great tool. It assists you in accomplishing many, many things. But like any tool, if it's not used properly, it could cause problems for your business. Before taking on debt, it's important to consider the benefits, the true cost of borrowing, and your ability to repay the amount borrowed, right? And you'll hear us refer to these things a couple times. So what we'd like you to do is to start, right? Before you do anything, it's important to make sure that there's a clear benefit to taking on debt for your business. So I want you to ask yourself the following two questions. First, what is the purpose of this debt? So clearly define why you need the debt. Is it for expansion? Are you purchasing new equipment, managing your cash flow, any other specific purpose? Because understanding the purpose will help you determine if the debt is justifiable, right? And then we want to look at it, even if it's justifiable, good debt will actually help improve the business. So the next question is, how will this debt improve the business, right? So how you want to assess how those funds that you're borrowing, do they increase your revenue? Do they improve your efficiency? Do they provide any other significant benefits? So whenever you're going to consider taking on debt, start please with those two questions. And then as you answer those questions, think about how that impacts you in the long term, right? Debt might be a great choice if you are thinking about expansion and growth, because it'll provide capital to allow you to either open a new location, renovate an existing one, invest in additional locations. Investing in quality, debt can help you invest in quality. So if you're looking for basically you need to take in some additional funds to hire qualified staff, to enhance the educational programs, upgrade the facility, as we mentioned, continuing to receive, I should say, obtaining continuing education or certifications or accreditations. Debt also, as we know, can help in times of when you need financial relief and you need to basically increase the resilience of the business, right? So that can be a safety net. So debt could be a safety net. But the key is that the responsibility of debt repayment and the experience of keeping up with that debt. And you want to think about also the money that's lost to interest. Sometimes those are outweighed by the benefits of what you're buying. So, for example, a loan to renovate a room in your childcare facility that would allow you to take on additional children, that might provide you with enough revenue to quickly repay that loan. that's a great example, right? That could lead to a permanent increase in revenue. So we like that kind of debt. All right. So we do need to stop and think. We've asked ourselves a couple questions, and now we need to understand the real cost of borrowing money, right? Goes, as we said, it goes beyond just looking at the amount that you borrow. We're going to think about the interest rate, how long it's going to take us to pay it back, what happens if we don't pay it back, and basically through those areas, you are potentially losing money, right? Because you're paying more than the original amount of the loan. So we're going to look at each one of these considerations here. All right. So what we want to do is basically look at the fact that there are two different types of interest. There's simple interest and compound interest. So simple interest is calculated on the principal amount of the loan or the investment. So you'll see simple interest loans, for instance, if perhaps you take out a loan from family or friends. Often auto loans are also loans that have simple interest. And what that means is that the interest is calculated on the initial amount, right? But not on any additional interest accrued over time. So an example would be if you borrowed $1,000 from a family member and that person is charging you 10% in interest monthly, basically the $1,000 that you borrowed, the interest would then be $100, right? So that debt becomes $1,100 that month. And so what will happen is that if you weren't to pay all of that back, you would not be making a payment of interest upon interest upon interest. But compound interest is the most common. It's what most of us know. And it occurs when the interest on a loan or an investment is calculated not only on that first amount of money that we bought, right, but also accumulated interest from previous periods. So it just kind of rolls and grows and grows and grows. So a lot of times you'll see this kind of interest on long-term loans, like when you're purchasing property, purchasing major equipment. An example would be is if that same $1,000 at 10 interest, the first month would be $1,000 plus the $100 in interest, like we talked about. But if you didn't pay anything, that interest, the interest that existed, right, now there'll be new interest calculated on top of that. So we were at $1,100, and now that means that we had $100 in interest the first month. The interest in the second month is 10% of the $1,100, right? So now it's $110 in interest, and that just continues, right? The next time it would be $1,210 owed versus that original $1,000 that we borrowed. That'll just keep going. It's one of the reasons why, whenever you're looking at something with minimum payments, you want to be very, very careful looking at the minimum payment, how much compounding interest can affect you. So just, you want to always understand the amount of money that you're expected to pay over time, because it looks really different than the amount that you first borrowed. So as I just said, right? So the consideration then, what it looks like, the amount of time, the duration of time it takes you to pay that loan there. Some loans have a fixed repayment period, right? They basically say, hey, you've got 20 years to pay back this loan. Now, that you could also have something like a credit card, and that duration of paying back that credit card goes on indefinitely, right? Until it's 100% paid off. So keep in mind that longer repayment times, right, may mean lower monthly payments, but they end up costing you more over the lifetime of that because of interest. Now, shorter repayment times, might mean higher monthly payments, but it would save you money in the long run, right? Because you're basically not going to pay on this interest upon interest upon interest. So before you decide to take on any debt, please think about how long you have to pay the debt, but also, the fact that the longer it is, the more interest you pay. So a lot of times when we go to purchase cars and they talk to us about, something that's I'm going to mess up the numbers, but let's say 30 months, 50 months, 60 months, et cetera, usually would be years. Those payments, or at 60 months, those payments are going down a lot lower. But when we think about the amount of interest that could be accumulated over that 60-month time period, it's very, very different than if we had paid more over the course of 30 months. So I always say to people, one thing that you want to just be careful with whenever you're borrowing a large amount of money is thinking about that duration, right? So we've thought about that. Now, what are some of the consequences, right? If we can't repay that, well, there's late fees. Late fees can add up quite a bit. You'll always want to be aware of what the late fees could be. If you fell behind on payments, you could go into collections. That would mean persistent calls from debt collectors. Those are coming into your business. They're very disruptive. Impact on your credit, right? So if we have late payments, it affects your credit score, and that could then affect the ability for you to get future financing or favorable terms. So good credit scores, maintaining a good credit score is essential for the financial health of your business. There also can be legal action, right? So if you default on the loan, those creditors can take legal action. They can garnish your wages, file lawsuits, put liens on your collateral. They can seize assets. And then, the last really tough position is if something is repossessed or foreclosed on. So if your loan is secured by collateral like property or equipment, failure to repay that, right, can basically result in repossession or foreclosure of those assets, that equipment, that property. And that, could you imagine, that really can disrupt your business operations, result in significant financial losses. So that's the list of things, right, that we want to be able to avoid there. One thing we really also need to think about is what's called opportunity costs, right? And that basically is looking at the money that's lost versus the money saved if you're using borrowing as a tool. So consider this, right? You borrow, you're paying interest to somebody else. We know that. But if you were to take that money and invest that same amount of money in savings for yourself, you're going to have the returns over time. Right? So what is that opportunity cost? Is it worth it to get into that debt when instead we could be using that money to build an emergency fund, or basically anything that we could pay for in full and not have to address the debt? So what you really want to do is you want to think about, how is this debt going to significantly impact you? Because what if you're committing money to debt and then you don't have savings and you could have put it in savings, right? So debt can be a really impactful financial tool, but it's really important to understand the opportunity costs of investing in debt versus investing in savings. So take the necessary time to evaluate which financial approach really best suits your business needs and your business objectives. So this is something that really will be very, very crucial if you do have debt, right? And that's creating a debt repayment plan. So let's take a look there. So whenever you take on debt, whether you have a choice or not, sometimes we have to take on debt that we didn't plan to, that we didn't expect or we don't want to. We have to think about, right, how are we going to pay this back easily? What do we need to do to be successful in those repayments? Because we saw what happens if we can't repay it there. So understanding first your minimum monthly payment in comparison to the accumulation of interest over time, right? We know the longer you wait to pay, the more you end up paying. So if you took out a loan of $100,000 with a 5% fixed interest rate, right? So that just means that that interest rate isn't going to change for the lifetime of that loan. And you do this to purchase real estate for your childcare business. If you paid steadily throughout 30 years, because we know often property loans are 30 years there, or whatever the term of the loan could be, you basically would have paid $193,000 on the $100,000 that you've purchased, right? So almost a purchase, that you financed, that you received from credit. So that's nearly double the original cost of that purchase price. So we got $100,000 to buy that house or that building or whatever it was. But at the end of the day, if it takes us a full 30 years to purchase it, we've paid $193,000 for it. 93,000 extra dollars because it took us 30 years to pay that back. And that's with a fixed interest rate. There are so many loans out there where the interest rates can change and you could get yourself into quite a bit of trouble with a higher interest rate later in the loan period there. So you also want to think about the fact that we were just talking about a 5% fixed interest rate. The interest rate for credit cards is often much more expensive. We see 20%, 25%, 29 or 30% there. So if you made a purchase with a credit card that's a $10,000 and you have a much higher interest rate, that balance on that credit card could double in less than 4 years. So in less than 4 years, you could owe $20,000. Of course, you'd be paying it down a little bit at a time, but with crazy interest rates, if you're paying the minimum, you are not really reducing that the principal of that loan, the original amount of that loan, it just continues to snowball. So what do we want to do? We want to prevent it from happening. So we create a debt repayment plan. And what we want to do is we want to look at what's the maximum amount of money that you can afford to pay each month so that you can minimize those interest costs over time. All right. We want you to basically start with the cash flow forecast. You hear a lot about cash flow, very crucial element to financial health for a business to really understand, because if you have a cash flow, you understand your monthly income and your expenses, right? That gives us a clearer picture of the financial situation, and it helps determine how much you can allocate, how much can you pay towards debt. Then we talk about affordability. So based on that cash flow forecast, how much can you realistically allocate towards the debt, right? So basically we're looking at the cash flow forecast and we're using that to calculate the affordability. Then we're going to set a repayment goal. So we're going to basically say, hey, we're going to pick an amount of time that we are committing to repay that debt, right? What we can afford, but looking at it through what type of payment, how much of a payment can we use to make the most amount of impact. You will want, in terms of a repayment plan, to think about making additional payments whenever possible, right? So if you have additional funds, consider putting that money towards your debt because you will pay it off faster and you will pay less interest charges, right? So the amount of money that you finance to begin with, you will not be paying a huge amount by the time you've paid it off, right? So think about sometimes when you get a little bit extra money, whether it be a bonus or a tax refund or anything like that, it's really great to put that money towards debt there. And then what you want to do is you want to be able to monitor that progress, right? So we want to track our debt repayment. We want to take a look. We want to see that progress. It's very exciting when you see debt being paid down across time. You set a goal, you work for it, and you're able to repay that, hit your goal. It's great. And as you are increasing basically you're reaching your goal, you're monitoring that process. Progress, you basically could perhaps add on some more money every time, but it becomes very, very motivating. I will say to anybody, total aside, this isn't in my presentation, but if you're curious, go to TikTok and search for like debt repayment, or there are so many people on TikTok sharing their financial situations and showing very transparently how they're paying off debt. It's very, very interesting. It can be motivating. So we know that taking on business debt, right, it's a significant decision. If you prepare for the responsibility of it, it can be, as we said, a great tool for your business. And we want you to be able, when you borrow money, to leverage that for growth, right? Improve everything. So whenever we're borrowing money, we're thinking about, remember we talked about you looking at it as, what is this going to do for me? Is it going to further my business in terms of my success? All right. So we're going to talk about some debt reduction strategies, but I do want everybody to think about, and this is hard to do sometimes, is to assess your current debt situation. All right. And it's hard because a lot of times we want to, if we have debt, we want to ignore the debt that we have. It's not going away, and putting off addressing it is only going to put us further into problems there. So there's no necessarily a set in stone debt to asset ratio, but we do find that childcare businesses, if you have more than 30% of debt compared to your annual revenue, right? So if 30% or more of your annual revenue is debt, that's considered to be a very high risk, a significant risk there. So keeping that in mind, right? We want to think about our debt in relation to, or the percentage of our debt in relation to our overall revenue. So really what you can do is you will look at the debt to asset ratio. There is a metric. Everybody think about, commit to memory to Google debt to asset ratio, because there are calculators that will help you with that. And that metrics, what it will do is it will show you some insight into the proportion of assets that are financed by debt. And it helps you show basically your financial picture. Okay, so debt to asset ratio is very straightforward. It's basically your total debt divided by your total assets, but it can be really easy to use a calculator there. So we need to assess the debt. We're not going to hide from it anymore. We're going to gather all of our documents. Okay, everything that we possibly can for our business, not just the things pertaining to that borrowed money. I want you to gather everything as if you're preparing for tax season. And then what I want you to do is to think about all of the assets that your business has, right? So everything you own, the balances in your accounts, money that perhaps families haven't paid you yet, any investments that you have in equipment, even your furniture and things like that. And if you own your building, the value of your building counts as well. All right, so we're looking at, that's determining all of our assets there. So basically we're making that list, and we know that cash is worth the amount that you have, right? Money owed by parents is not immediately available. So think about right now, how much is all that stuff worth, right? If we're talking about furniture and toys and books, it would be based not necessarily on what you paid for them, but what could you get for them now, right? So thinking about things depreciating over time, right? We need to take that into consideration there. Once we've done that, we're going to confront the monster, all right? And we're going to write down what we owe. So we're going to think about, and not just perhaps for that debt, but all of the money that we have to pay back, all the bills, the loans, anything else that we borrowed, our utilities, our rent, our insurance. If you leased your building, you're going to include the lease payments. If you bought your building, you're going to include the mortgage payments there. We want to take a look at that. We want to see how much do we owe for each item, right? Because that's our overall debt. So, okay, what we're going to do is, how much is this business actually worth? Well, we have all the information that we need now to understand what that picture looks like, all right? You take all of those assets, and then you subtract all of your liabilities, everything you owe money on, right? And that's your equity. That's basically the equity that you have in your business. So it actually shows, interestingly enough, I want you to think of equity as the amount of your childcare business that you actually own. We never really think of it that way. So debt to asset ratio, right? That's really what we need. We need to know, because we're going to keep that percentage in mind, right? So basically take all of the liabilities, divide it by the number of the total assets, right? So everything we owe divided by everything we own of value, and multiply that, after we divide it, multiply that by 100. All right, and that's the ratio that shows your business assets are financed actually by debt. So in this particular situation, right, we have a situation here where overall all of the debt is $75,000. All of the assets are worth $120,000. And basically their debt to asset ratio turns out to be 62.5%. That's a lot of debt, right? If everything I have that I have is worth $120,000, but when I take all that debt into account, it's $75,000. Boy, right? That's showing us really we don't own as much of our business as we think we do. So you want to stop and think about that. A lot of times people don't think about that, what that scenario looks like. All right, so what do you do if the debt is too high, right? Kind of daunting, it's scary. We took a look at that. Let's look at some practical steps. Cash flow surplus, right? What does it mean? We're going to use and maintain our budget. We're going to use and maintain our cash flow because what we're looking for, right, is additional money that we can use perhaps to pay off debt. A lot of times you can use technology, automation, things like that that save you time because time really is money. The faster that you can start paying things back because of your organization, because of the way that your bookkeeping systems work and things like that, it actually plays a role. I think a lot of times we don't think about that. I'd like you to think about researching credit cards for lower rates, perhaps lower or interest-free balance transfers, right? So we can look and see, is it possible we have a high interest credit card and now there's a circumstance with another bank that if I transfer my balance and I pay it off, let's say in a year, I'm not charged any interest. Of course, we need to make sure we can pay it off in a year because if we don't, interest actually, they charge you interest from the first day that you borrowed that money. But those can be really good ways. I'd like you to look at your bills and think of all the things that you could cancel, right? Because we're thinking about we need that cash flow surplus. So could be small things, right? Could be little things, could be subscriptions, could be reoccurring costs that you forgot exist. Look for all of that. And then look at shared service alliances in the area, right? So they can help you by having collaboration. Perhaps they can help you decrease costs, share resources, perhaps get better rates on supplies and services. So really what you want to do is you can approach DECAL and say to them, how can my business work with resource and referrals? How can I work with shared services alliances? What can I do? So a lot of times there's central payroll processing and things that may be less expensive than what you're paying now. All right, so we've got that actual extra money now in our right? We have a surplus in our cash flow there. So now we're gonna take that surplus and we're gonna put it towards our debt repayment. So we're gonna set a goal and we're gonna stick with it. So we're gonna calculate how much a month can we afford to pay towards our debt, and then really start, really kind of jump in, right? So think about, you've got the budget, you've got the cash flow, you understand your financials, beautiful picture of your financials, and what is realistic to put as repayment to your debts every single month, right? We know they have to be at least the minimum payment, but we're looking for far greater than the minimum because we want to pay that debt down fast, because the faster we pay it off, the less money we spend, the more money we get to keep.
Close the door for me.
So I just need everybody to mute, please.
So that
Thank
man
you.
passes in before they come in.
Carlos, I'm so sorry. Aaron, I probably need you to mute. Thanks. Okay, so we've done that. Step number 3, prioritize the debts for repayment. All right, we're going to look at all the debt and what is the best repayment strategy. We want to take basically impactful steps to reduce the debt. So I want you to think about a few different factors: interest rate, the minimum payments, total balance. We're going to structure a plan for repayment. We get everything together. We look at the total balance. Basically, we think about those minimum payments. We evaluate what they are. Really, what you'll want to do is focus on any type of debt that you have that has higher minimum payments. All right, because those are they significantly impact your monthly budget, and we want to get those paid off as soon as we can, right? So we're going to look for the things with higher minimum payments. We're going to look at interest rates because the highest interest rates, right? That's what's going to cost us the most amount of money over time. So looking at those things, right? Okay, minimum payments, we're looking for high minimum payments, we're looking for high interest rates, and we're putting things in order of which, of how we're going to pay this debt off. We've got that surplus. Where is it going? It doesn't necessarily just get divided up evenly between our debt. We want to look at what's going to be the most impactful for our bottom line, because the great thing is, right, we pay off one debt. Now we've got that money in addition to the surplus to pay off more debt, right? So as we pay off debt, we take the money that we were paying and we put it towards the next debt. And we just continually look at that, that great progress of paying back debt as fast as we possibly can. All right, so basically you looked at that debt to your debt to asset ratio, right? So we want to get to the target, right? We want to get to a reasonable, basically want to get to less than 30%. So at less than 30%, it is considered to be perhaps manageable debt level. It does vary per business, all right? So think about 30, we want to go lower than 30%. What's our target, right? We start to look at everything, right? We do the debt to asset ratio there. Again, right, you take your total assets, and an example would be if those assets are $100,000 and I'm looking for a 30% asset to debt ratio, right? I take the 30%, I multiply it by so 0.30, right? If I was using a calculator, I multiply that by $100,000. Okay, $30,000. In order to get to what that 30%, I need to pay back $30,000 there. So we have an idea of what it is that we need to repay. Now, what we want to do is look at how much do we pay, right? Well, how much do we have versus our target, and that can help us pay our debt faster. Focus, right? It's focus there. So if your target was $30,000 and it turns out that your current debt is $50,000, well, we know we're going to pay $20,000 as fast as we reasonably can without putting our business in jeopardy. So we've looked at that debt to asset ratio, right? We've got a goal where we've put our debts in order of repayment by looking at everything. Now we're going to make a plan. We're going to put it in the computer. We're going to write it down on paper. Whatever we need to do, we're going to have a plan. All right. So let's look at an example here. So we have Aisha. So she's determined that she's going to improve her business's financial stability, and she's going to reduce her debt to asset ratio from 54.4% to 30%. How's she going to do that? Well, first, she looks at her debt to asset ratio, right, to determine that it was 54.4%. In this instance, she had $125,000 in assets, $68,000 in liabilities, in debt, right? She knows that she wants to get to 30%, her debt to asset ratio to be 30%. Well, when we look at all of that, we do the calculation, it means that she needs to bring that debt down to $37,500. All right, so then she's going to look at that cash flow surplus. How much can she pay a month? In this instance, when she looked at everything, she could pay $1,200 a month towards debt, right? That is basically her cash flow surplus. Her surplus happened to be $315. She was paying towards debt, right? So she was already making payments, the extra $315 there, because her current payments, she was paying $885. She found a surplus of $315 a month. Now she's able to pay $1,200 a month. All right. She knows now what she's going to be paying to get herself to that 30% debt to asset ratio as soon as she possibly can. All right. So she goes and she prioritizes that debt, right? Looks at the credit card debt, the balances, the interest rate, the monthly payments, thinks about how long should she take to pay that off. She does the same thing with her car loan. Takes a look at her car loan, right? Basically, how long does she have to pay that off? And this presentation is going to be recorded so that you actually can look at these numbers a little closer. Okay, I won't go into all of the numbers, but I would love for you to, this will be posted on the Civitas Strategies YouTube channel for DECAL. And I would love for you to look at these numbers and kind of see the math themselves. Like I said, we've got a lot to go over today, and we don't have as long as I would like. So on there. So fantastic. Aisha is moving towards that debt to asset ratio that she set as a target. When she figured out the credit card repayment, when she looked at the car loan and she figured out how long it was going to take her to pay down the debt, all of the calculations basically worked up to be that she could get to that 30% debt to asset ratio in a little over 28 months. All right. She, in terms of thinking out her calculations for the amount of time, 6 months for the credit card, 12 months for the car loan. She's basically going to do another 10 months to help adjust her mortgage down. So putting money towards not just her mortgage payments as a whole, but towards her principal and everything. When we added everything together, it worked out to get her to that 30% ratio, 28.4 months, right? So a little more than 24 months. She's got a target. She is not hiding from her debt. She knows how long it's going to take to get her to the 30%. I bet this is human nature. When she gets to that 30%, she's going to be motivated. What is it going to take to get me to 20%? Right? It's basically, it's a great thing about human nature, right? As you see those numbers go down, you become more and more incentivized to pay off additional debt, to get yourself in a great position there. So how do we do these things? We pay more than the minimum. Do not fall into the trap of only paying the minimum amount. We want to reduce as much interest as we're going to pay over the course of that debt as possible. Please be consistent in payments. We want to think about, basically allocating the same amount of money, always remembering to take that surplus and to make sure that with our cash flow and our budget, we're able to make very consistent payments there. We're going to be disciplined. It's hard. In order to hit our financial goals, right, we may need to make some sacrifices. We may need to change the way that we spend our money. Setting up automatic payments is fantastic because it's like set it and forget it, right? So basically your payments would always be made on time every month. You wouldn't be paying late fees. The money, basically it leaves your account. You're not holding on to it. So automatic payments are great. Use technology, set up calendar alerts, use your phone for reminders, any type of scheduling apps if you need reminders about when balances are due, set up notifications. And then also you can look at basically staggering payments, right, across paychecks. So if you got paid bi-weekly, 2 times a month, you actually can plan very smart when that money should come out. And a lot of creditors will allow you to adjust the due date of your payment. A lot of people don't know that, but basically look at when you get paid, how much you get paid, what's due in that time period. Do we need to move some things around? Look at basically stagger the payments, right? So it's not like on the first of the month, everything comes out. Let's stagger the payments so they are reasonable with the incoming money that we are going to be receiving. So I want to think about that there. We can do everything right. We can have a solid plan, but sometimes debt does become unmanageable. So what should we look for, right? We're learning how to assess and manage our debt. We're really thinking about the financial health of our business. Constant and consistent application of those steps, you're going to strengthen your business's financial, your base, your finances. But sometimes you find debt levels challenging to manage. Situation seems severe. Then really you're going to think about how are we going to We're going to recognize debt issues. What are we going to do? So every once in a while, from time to time, businesses do have financial strain, right? And we're working to reduce our debt during that period because we want to control it. We don't want it to control us. So basically, again, let's look at the debt to asset ratio. Let's take a look at that. Are you having a sign of your debt being out of control? Are you having difficulty making the monthly payments, right? So if our debt to asset ratio is above 30%, we're having difficulty making monthly payments. Are those balances just growing and growing and growing because of interest, even though we're making payments? Because that means we're not paying enough, right? And we're just in that cycle of things building and building and building. And then, are you relying heavily on credit cards for your everyday expenses? Those are some warning signs, all right? When we think about the payments for your debt, basically consumer debt, are those payments 50% or more of your income? Right? That could be huge. Are you receiving calls from creditors, right? Are you being hassled and in a constant feeling of stress because the phone won't stop ringing or nobody answers the phone anymore, right? But basically, you're really being hounded by people collecting money there. Big one, credit cards maxed out. Is there no available credit? Your credit rating, is also based on the amount of available credit that you have. So when you get in these situations where your credit cards are maxed out, chances are you may only be making the minimum payment or only a little bit of the minimum payment. That's a sign that wow, things have to change. You need to think about that there. And if you're at this point where we talked about cash surplus and you think, how, Jen, there's no way because I'm having a hard enough time saving up to pay down this debt. I have no surplus. All right, we want to just kind of think about it because we may be in a position where we need to think about perhaps some professional help, right? Debt may be getting out of control. So there are options available to help you manage and reduce your debt. So we're going to take a look at a few of those. There is credit negotiation, right? So a credit negotiator, they talk directly to your creditors and they're looking to get favorable terms. So lower interest rates, maybe extending the payments. We don't love that, right? Because we're going to pay more money over time. But if we're in a position where we're really strapped for cash and it's very, very difficult for us to make payments, that may have to be the option, right? Not every creditor is going to allow negotiations, but it can help make your debt more manageable, all right? You have to understand before you meet with that creditor negotiator, I should say, you need to make sure that you know what you realistically can pay because they're going to ask for that. What amount of money is in your budget that you're going to be able to pay towards these debts? And then they go to work to try to negotiate lower interest. There are some nonprofits that do this. So do some research. There also are for-profit companies. I will tell you that there are also some very sketchy for-profit companies. Do your research. Look to see, are there any complaints filed against the credit negotiator? What does it look like? How long have they been doing this? Are there legitimate success stories that you can basically make sure that they're valid? Ask others that perhaps have used debt negotiators. So don't just think that anybody who claims to be a credit negotiator is going to be able to help you. Please research. We know, right, in every area of life, boy, there are people out there to get us, right, and are not there for our best interests there. There is also the next option is debt settlement, all right? And basically what that means is that you just pay a lump sum to a creditor and they do not pursue collecting the remainder of that debt, all right? Basically, you are going to need that lump sum of cash. If this is for the business, just so you know, business debt is considered to be taxable. How do I put this there? If you're looking for a settlement and you write off debt, I owed $10,000 and they were willing to take $5,000. That other $5,000 is considered to be taxable income. So please just be careful when it comes to debt settlement. It can be a great way. It can help you avoid bankruptcy, but it also is a huge ding on your credit, just so that you know. There are debt management programs. These are also often nonprofit organizations. They help you with financial counseling. They help you consolidate your payments into perhaps a single monthly payment that feels more doable. They can help sometimes get your monthly payments lowered, extend, right? So very, very similar to that that we talked about, that the credit, why can't I think of it, but the person basically helping you negotiate terms and things like that, the debt negotiator, credit negotiator, similar to this, right? But again, make sure that they're reputable, please. Nonprofits are a great option. There are often fees associated with all of these types of assistance. So you want to look at how much is it going to cost you? What are the all of the services that are available to you? All right. Debt counselors, that's about personalized guidance and report. They often are nonprofit organizations, okay? They need to be certified. They need to have a good track record. Basically, they would have fees, but usually they are relatively low, because there are nonprofit organizations that specialize in debt management and they specialize in financial education without the motive of profit. All right, so they're going to help you with structured programs. They're going to give you a lot of financial education. You'll want to look for organizations that are accredited by the NFCC, which is the National Foundation for Credit Counseling. That's if you find someone who's accredited by the NFCC, you are most likely working with an organization that is going to be of great help to you. Financial advisors, right? They can help you with comprehensive planning, debt management, long-term strategy. So think about that. Look for individuals that have certifications. CFP is one type of certification. You can ask bookkeepers, your lawyers, and anybody, do they happen to know any good financial advisors? You want to know how much they're charging. Credit unions are also a great way to find lower interest rates on loans. They have financial counseling. I personally love credit unions compared to the big banks. All right, they usually are they're usually much easier to work with, less fees. I know sometimes credit cards from credit unions, loans from credit unions have lower interest rates there. You'll see that you do have to be a member of a credit union, but sometimes it's as little as $25 or $50 in an account. So don't let that put you off there. What are you going to do? You need to find the best option, right? What does this look like? Please research, please check credentials, read reviews, ask questions, trust your instincts, right? All of these are going to be the key to making sure that you are making the right decisions. Now, in very severe situations, professionals may recommend that you file for bankruptcy. All right, so let's look at that. There is Chapter 11 bankruptcy. And what that does is it allows a business to reorganize all of the debt, continue operations. It's basically if your business has potential for future profitability and you need time to restructure your finances, Chapter 11, you will need help filing. And it can be costly to file because that assistance can cost you quite a bit. Chapter 13 bankruptcy is basically becomes a repayment plan. So you get to keep all of your assets. There's a fixed plan over a certain period of time. Often your debtors have to agree to either waive or lower interest rates there. But Chapter 13 allows you to handle business debt. It is also available for personal debt there. It's a repayment plan. It helps keep you on track there. And then we have Chapter 7 bankruptcy, all right? And that basically is where you're going to have to liquidate your assets, right? So what's going to happen there is you're going to have to sell your assets. It's usually used by individuals and businesses that cannot realistically pay off all of their debt. All of the assets are liquidated. That money goes to pay off creditors. Chapter 7 usually means that you're going to cease operations. Okay, so just keep that in mind there. So there are a lot of different ways, right? There are a lot of different ways to tackle high levels of debt, regardless of which option you choose. Look at these steps, please, as the beginning of a recovery rather than a negative ending, okay? Options can lead you to a clean slate. They can help fix these things for you. So it might be challenging to navigate, but just set that goal, stay, really dedicated to your repayment plan. Focus on creating healthier, more sustainable financial businesses, because when you receive that help, it can really, obviously, point you in the right direction and be the relief that you need. So let's remember that debt can be a tool, but we need to think about the cost of that debt. We're going to look at our debt to asset ratio. We're going to get a plan. We're going to stick to that repayment plan. We're going to be always aware of those warning signs. Don't hesitate. If you need help, get professional help. And what's that last key part? You're in control of your financial future. You are successful business owners. You can do this. You can make the right decisions towards taking on debt, and you can basically empower yourself to pay back debt. You can say easier said than done, and I understand that it's scary when you're in debt. It can be overwhelming. But when you break it down and you follow steps, and again, this video is going to be posted on the Civitas Strategies YouTube channel. You'll see the DECAL logo there. You can just search for debt on Civitas Strategies. This will be posted. DECAL, I believe, also will be posting it, but I just know that we posted on our YouTube channel. So by all means, please take a look at that video if you want to go back and refer to any of this. I want to thank DECAL for having us here today. We have a few minutes and we're going to answer some questions. I just want to, say, please don't forget to go to the DECAL's Thriving Childcare Business Academy website. Look at they've got the webinars posted there. They've got bilingual guides and videos, the one-on-one coaching, I think right now is paused, but there's an estimator tool if you're having some difficulty with the CAPS payments, with figuring out your CAPS payments, your Q2, C2Q payments. There's an estimator there. I'm going to leave this slide up because if you have questions that you think about after we leave, if you have questions that we don't get to in the next couple of minutes, Civitas Strategies, we're the steward of Tom Copeland's blog, so tomcopelandblog.com. There are over 1,500 resources there. Chances are you can find the answer to your question, but if you don't, there is a section that says Ask the Experts. You can click on that, ask a question. Once a month, I go in, I collect all the questions, I videotape, how old am I? I record my answers through Zoom, and I post that on the Civitas Strategies YouTube channel. So please, by all means, if you have questions after the fact, please feel free to reach out. So do we have any questions? We are right at time. Boy, 2 minutes to spare. Anybody, you can come on off mute. Aaron, is there anything in the chat that I could be helping someone with?
Yeah, so there was a couple of questions. One of the first questions was by Wanda. Is it better to get a longer loan and pay it back sooner?
So repaying a loan here's my theory on that, Wanda. The longer loans can be safer, right? If you're not sure that you would be able to make a higher payment. But the sooner you pay off any loan, the better, right? So if you do take a long-term loan because you're not sure, right? There could be some bumps in the road in terms of how much you could repay every month, and then you find out that you can make higher payments and repay that sooner. That can be a very smart strategy if you are concerned about perhaps the amount of debt that you could pay a month it fluctuating, right? Needing to address that. So I totally understand that logic. There are calculators online where you can put in the terms of any loan, and it will tell you based on interest and the amount of the loan, if you took the entire length of the loan, how much that would cost you to do that. There are credit card repayment calculators. You can play around with those. So I would just suggest that to anybody. Aaron, another question?
Okay, so you answered this other question within my first question, but the second question that I have is from Amanda. Is mortgage debt included in the 30% debt to asset ratio?
It is. Well, how should I put that? Amanda, can you put it's Amanda, am I right?
Yep, Amanda Schaefer.
Yep. Amanda, could you just put your email address in the chat, and I will get back to you, because I just want, I should not just say yes automatically. I need to take a couple things into consideration. I would hate to give you incorrect information. So I say immediately I jump to yes, and then I think about the amount of most mortgages, and yeah. So I'm going to look into that. Amanda, please put your email address for Aaron and I in the chat.
Okay, the next question from Wanda as well. Do you include payroll in debts?
Traditionally, no. Considering that it's considered to be an operational expense. So I hate to say this, these are great questions, guys, because they're not things that I think about very often. Because payroll comes and goes so fast, it is rare that someone adds that to their ongoing debt, right? That is an expense that you have twice a month or just continually. And when we're looking at debt, we're usually looking at a bit of a larger picture. But we did say, right, you gather all the debt. So here I go again. Wanda, can you do me a favor and put your email address in the chat? And guys, this is because Civitas does not guess. We never guess. If I don't know 100%, if I don't have if there's something I want to run by somebody, we have the resources that I can do that. So, so Wanda, we're going to find out about payroll. My belief is no, but not 100% sure. So don't anybody quote me. Let's find out what that's about. So, all right. And Aaron, if you get a chance a little bit, to see if Wanda was able to put her email address in there for me.
Yep, I've gotten both Wanda and Amanda's email.
Fantastic. Just another reminder, everybody, please put your PDS numbers in the chat. And any other questions there, Aaron?
Those were the only questions that were asked in chat.
Okay, so everybody knows you can go to the Tom Copeland blog, and there is the Ask the Expert option. So if you think of things, Amanda and Wanda, you will hear from me. I'm going to be emailing you with the questions. I may need a couple other details, and then I am going to commit myself to record those answers in my monthly Ask the Experts video. So if anybody is curious, you can look for, we're now in February, so the middle of March is when I usually post answers, middle of the month for the previous month. So I'm going to address those questions in Ask the Experts as well. So if you attend, look for my video on YouTube. All right. If we have no other questions, we're at 4:03. You made it through. I know this was a lot. So,
hey, Miss Jennifer, what is your last name? Because do we supposed to do a survey on this?
oh, so my last name is Vail, V as in Victor, A-I-L. And I
okay, because the survey gonna come back, right?
I believe so. Yeah, I'm never involved in that, honestly, Tawana. They don't. I believe it's automatic, but
right.
I couldn't guarantee you that. They keep me out of the surveys, right? Because we need 100% honesty. So, and I always appreciate any type of feedback on the content, on my delivery, anything that you would like. We like that.
And then, Aaron, when will the certificates be available?
So my understanding is that the certificates, God, Aaron, did Margaret tell you when those are released?
She did not tell me when they will be released, but if Tawanda, if you want to drop your email, I can get that information and then email you.
Tawana, I want to say it's within 2 weeks, but I shouldn't commit to that either. Yeah.
Oh, that's fine. That's fine. Okay. Because I know I see it in an email. Okay.
Yeah, and shame on me. Aaron, yell at me that I didn't know about the certificates, because I'm sure at one one point I knew about the certificates. It's just my old brain can't remember everything. So. All right, everybody. If there's no other questions, I want to thank our interpreter Emily for joining us today. Emily, were there any questions in the Spanish channel? Maybe we should. Okay. All right. I appreciate it. Thanks, Emily. I just thought I better not make an assumption. So, okay. All right. So I'm going to stop that. So we are finished, folks. So thank you.